Welcome to The Explainer. There's a question that has obsessed people for ages. Can we actually predict the stock market? It's like the ultimate financial puzzle. For the longest time, the official answer was pretty much a hard no. But now, with the incredible rise of artificial intelligence, a whole new generation of researchers is starting to ask, are we sure about that?
And hey, it's no surprise, right? More of us are involved in the market than ever before, and I bet almost every single one of us has stared at a stock chart, maybe on our phone, and just thought, man, if I only knew which way that was going to go. That promise, that little bit of an edge, is just so tempting.
So that really is the billion-dollar question, isn't it? Can a machine, an AI, see patterns that the human eye just can't? Can it consistently beat the odds? Or is the market just, a totally random walk, basically a coin toss, where no amount of genius can guess the next flip? All right, let's dive in and find out.
Okay, so to really get a grip on this challenge, we have to meet the main villain of our story. And it's not a person, it's not a company, it's a huge, powerful economic idea that was considered financial gospel for decades, the efficient market hypothesis.
The EMH is actually beautifully simple. It says that at any given moment, a stock's price already has all the known information baked into it. The good news, the bad news, the past performance, economic forecasts, all of it. So if that's true, the only thing that can move the price is new, unpredictable information. And if the information is unpredictable, then so is the market. Trying to beat it is a fool's errand.
And this theory comes in 3 flavors, each one tougher to argue with than the last. The weak form basically says looking at old charts of prices won't help you. The semi-strong form says don't even bother with public news or earnings reports. That's already in the price too. And then there's the strong form, which is the toughest of all. It says not even secret, illegal, insider information can give you a consistent advantage. In its purest sense, the EMH says the market is flat out unforecastable.
But, and here's where it gets really interesting. Over the years, people started to notice little cracks in this perfect theory. They found these weird anomalies, like the market totally overreacting to some news, or stocks gaining momentum in ways that just shouldn't happen if everyone was perfectly rational. This gave rise to a whole new field called behavioral finance, which just admits that, hey, investors are human. We're driven by fear and greed. And it's right there, in those cracks, in that human irrationality, that today's AI forecasters see their chance.
Right, so if you're going to go up against a theory as massive as the EMH, you better come prepared. You need some serious tools. And for a long time, investors have basically had 2 main approaches in their toolkit.
On one side, you've got fundamental analysis. Think of this like being a detective. You're digging through a company's books, checking out its management, its debts, its sales, trying to figure out what it's really worth. Then on the other side, you've got technical analysis. This is more like being a pattern spotter. You're just looking at charts of price and trading volume, believing that history and human behavior tend to repeat themselves in predictable ways.
And now we have the new challenger on the block, machine learning. And this isn't just a fancier calculator. AI is totally different. It's designed from the ground up to handle what the market really is: chaotic, noisy, nonlinear, and just unbelievably complex. It doesn't just look at 1 or 2 things at a time, it can look at thousands.
So how in the world do you actually build one of these things? Well, the process is pretty methodical. First, you've got to choose what data you're going to feed it. Then, and this is a super important step, you have to pre-process it, basically clean it up and get rid of all the noise. After that, you train your AI model on a whole bunch of historical data, then you test it on data it's never seen before to make sure it actually learns something. And if all goes well, you unleash it to make new predictions.
Any model is only as good as the data you feed it. So what exactly is on the menu for these prediction AIs? Is it just stock prices? Oh, not even close. The diet is way more vast and varied than you might think.
Okay, get this. The massive study that this whole explainer is based on looked at 138 different scientific papers on this topic. Across all of those studies, you want to take a guess at how many unique different variables researchers use to try and predict the market? 2,173. The sheer scale of the data they're throwing at this problem is just mind-blowing.
So what is all that data? This is what I find so fascinating. A huge chunk of it, 62%, is what we call technical indicators. So that's data that comes directly from the market's own activity, its own price and volume. In other words, the AI is primarily learning by watching the market's own dance moves.
And if you've ever looked at a trading platform, you'll probably recognize these names. You've got the RSI, which is kind of like a momentum meter for a stock, telling you if it's overbought or oversold. You have things like simple moving averages, which help you see the general trend. And of course, the famous MACD, which is great for spotting changes in a trend's momentum. These are the absolute building blocks for the AI's analysis.
But it's not just about numbers on a chart. That other slice we saw is where things get really wild. Researchers are feeding these models the actual text from financial news articles, reports on the economy, and yeah, even the mood and sentiment of what people are saying on Twitter and other social media sites. The goal is to capture the whole picture, not just the hard data, but the human emotion driving it.
Okay, so we've seen the ingredients, we've seen the data diet. Now let's pop the hood and look at the actual engines that researchers are building to crunch all this information. What do these AI prediction models actually look like?
You can actually watch the evolution of these tools happen right here over time. Back in the 2000s, you saw the first real emergence of things like neural networks and support vector machines. Jump to the early 2010s, and models based on fuzzy logic got really popular because they could handle the market's uncertainty. And then in the late 2010s, everything changed with the deep learning explosion.
For a really long time, the field was dominated by these three heavy hitters. You had artificial neural networks, or ANNs, which are kind of modeled after the human brain. Then you had support vector machines, SVMs, which are just really good at sorting and classifying data. And of course, those fuzzy theory models. For years, these were the workhorses of financial forecasting research.
But the new superstar on the scene, without a doubt, is deep learning. Think of these as neural networks on steroids with way more layers, which lets them learn much more complex, subtle patterns. And one type in particular, called long short-term memory networks, or LSTMs, has become huge. Why? Because they're specifically designed to remember information over long periods, which is perfect for finding hidden patterns in sequential data, like, say, a stock's price over time.
So, we have absolutely mind-boggling amounts of data. We have these incredibly powerful, sophisticated AI models designed to find patterns in chaos. And it all brings us back to that one single central question. After all of this, does any of it actually work?
Well, success gets measured in a few different ways. Some studies look at a hit ratio. Basically, how often did the model correctly guess if the market would go up or down? Others measure the error. How far off was the price prediction? And you'll see papers with these staggering results, like hit ratios near 90%. But, and this is a huge but, these are almost always results from controlled academic settings. In the real live market, things change. And a model that was trained perfectly on the past can get completely fooled by the future. It's a massive problem called overfitting.
And you know, this quote from the researchers themselves just perfectly sums up where things stand. They admit this is one of the most relevant, but also one of the most ridiculously challenging problems in all of finance. There is no single model that has been crowned the champion. The market is a constantly moving target, and finding that consistent, repeatable edge is still the holy grail.
So what is the big takeaway here? I think it's this. We have to completely let go of this idea of a perfect crystal ball. No model is going to predict the future with 100% certainty. It's much better to think of this as a constant, ongoing technological arms race. Researchers and quants build more sophisticated AIs to find tiny little inefficiencies. And as soon as they start exploiting them, the market itself gets a little bit smarter, a little more efficient, making the game even harder to win. It's a never-ending battle for a tiny statistical edge.
And that leaves us with this final, absolutely fascinating question to think about. As these AI models get exponentially more powerful, and as more and more people start using them, what happens? Will we finally see an AI that solves the market, that cracks the code once and for all? Or will the market do what it has always done? Adapt. Will it just absorb this new technology, making the game even more complex, even harder to win than ever before? The race is on.